away, guys.
Well, thank you, Daniel, and thanks to Planet DDS for allowing us to continue to host these webinars and be able to provide some valuable information. And welcome everyone, and thank you for taking some time out of your busy lives to really just discover some new ideas and gain some awareness around things that you may not be thinking about or possibly didn't even know about your business and your personal financial situation. So this webinar should take about an hour, and what we're going to cover are 3 key financial planning concepts that as a business owner you probably aren't using, and definitely no one is telling you about it. And we've really spent the last few years refining how we provide education. And some of the biggest learning lessons that we've had is when you provide education, you've just got to deliver. You've probably spent a lot of time learning things you already knew just to arrive in a place of further confusion. And what we hope to bring to your world today is just additional awareness, clarity, and understanding. My name is Josh Hohenstein, and on the call with us is Lee Daniels. And together we make up an arm of White Rhino Financial that's really just laser focused on helping dental practice owners make the biggest difference in their lives that they can. There's a lot of misconceptions and incorrect things out there competing for your attention, and our mission is to help you navigate those safely and make the best choices for yourself. I'll let Lee tell you a little bit more about himself, and I'll give some insights into myself after.
Thanks, Josh. I'm Lee Daniels, Senior Vice President here at White Rhino Financial, and over the last 30 years, I've been in a lot of financial roles on the corporate side at places U.S. Bank, Thriving Financial, and Waddell & Reed. Throughout my career, I've always felt that the most undereducated market that's been out there has been the business owner, even more so business owners that are practicing in the dental field. It's ironic that the small business owner is actually the backbone of our country. I've seen hundreds of instances where people are just doing things inefficiently. It's not because they're bad people or their CPAs or other advisors are bad people. It's just because the challenges and opportunities for a business owner are complex and very sophisticated. Not everyone is built to serve you as a business owner, or what's even worse than that is more often in my career, I've just seen it done incorrectly. Most of the time it's because the CPA, attorney, and financial professionals are not working in a cohesive manner to help you accomplish your goals. They're actually operating independently to achieve their own goals, and at the end of the day, the only person that typically pays for that is the business owner. So Josh and I, we decided to build our team and design it from the ground up to serve business owners with CPAs and attorneys and our clients' disposal. This is all about you. Josh and I created this team by understanding we both had a unique skill set, and we best serve clients by joining those skills together for the benefit of our clients.
And Lee is exactly right. Really where he brings experience and a vast amount of knowledge, I bring in attention to detail and precision, which is just really something that I developed serving in special operations in the United States Army and just training thousands of soldiers for over a decade. And really applying that for the last 4 or 5 years in the financial services industry. And with that being said, where it come from, any plan you make really only gets one shot to be correct. And by teaming together, we're able to drive high-level value with consistent accuracy to our clients' lives, and it all starts with education. And now the first question for most when they log on is, is this for me? And to dive a little bit deeper into that question, let's find out. And just ask yourself if you're open-minded to new ways of financial thinking. No one has a monopoly on all the good ideas that are out there, and what you're going to learn today you may have never heard about. And to know if you're in the right place is important. These strategies are designed for business owners, but they aren't exclusive to them. If you're working towards your financial goals, then this applies. Now ask yourself also if you understand that you don't know what you don't know. It's okay to leave today with questions, and we're happy to answer all of them to be sure you're comfortable with your understanding of it. And so we determine, this is for me. What am I going to learn? A few things that we're going to learn about these high-level concepts to be able to decide if you want to do something about it, but probably not enough to do it yourself. These types of strategies, as you'll see, are not DIY projects. We partner with CPAs and attorneys to build a team around our clients to accomplish this. However, really the value that you'll receive today is discovery. You'll learn a little bit about the value of a management services organization, a C corporation structure that may benefit you under new laws. You'll learn why it's not wise to put all of your dollars into a deferred tax saving strategy. And finally, you'll learn the power of executive benefit plans, a key strategy of the world's most powerful companies. And we've gathered some key and most common questions we get on these topics, and we'll reveal the secrets to the strategies at the end with a Q&A session. And so, we've determined, hey, it's for me. I'm going to learn some things. Do I need to buy something or send some credit card information at the end? I hate to disappoint all of you, but there's nothing to buy today. What this is designed to do is just educate and create awareness. You can go on and talk to your people about it, or you can talk to us. It doesn't matter for us. What we want is just for you to be in a better place, regardless of who helps get you there. But if it's us, we're okay with that too. Ultimately, at the end, you'll have a chance to set some time up and connect with us, or just keep on living your life. So now that our housekeeping items are out of the way, let's begin. So before we talk about really the hows, the whats, and the whys of everything, it's really important to understand the environment that we're in today. For things to make the most sense, it really requires a context for why they make sense. So the first part is that next year in 2020, the United States federal government is expected to rake in approximately $3.6 trillion of revenue. And so let's look at where that comes from. Now, 86% of that $3.6 trillion comes only from two places, from federal income taxes and federal payroll taxes, which include Social Security and Medicare. As a business owner, it's highly likely that you're paying both of these. And now, only 77% of our revenues actually cover what we spend as a country, which leaves a 23% gap that creates this deficit that we hear about all the time. So to kind of put this in perspective, if it continued at its current rate, every year the deficit we have to cover as a country by indebtedness is approximately 12.5 times the net worth of Warren Buffett. Now, stuff comes up that could change that, right? We also have no clue what's going to happen in the future, and as a country, we never have. So knowing we have to cover a gap in spending, and knowing we have to generate most of our revenue from taxpayers and businesses, it's inevitable that as the needs of our country have changed, the tax brackets would as well. And so most of you on the call probably know that for the most part over the last 20 years or so, top income tax brackets have remained relatively unchanged, but this wasn't always the case. Many times in our history, particularly during times of great national need, the top income tax brackets have been incredibly high. For example, in 1944, as you can see on the chart, it was 94%. So if you think you're unhappy with the taxes that you're paying now, just imagine how business owners felt then. What we also know is that in the years that the top tax brackets were lower, they're still subjected to being raised in the future. I mean, if we had a crystal ball, we could accurately strategize around what to expect over our lifetimes, but the reality is it's just that we can't. So by asking ourselves the right questions in order to stay on top of the most relevant ways to be current and consistent with the approach, this is not the IRS's duty to inform you of. It's your responsibility to empower yourself with the knowledge to take control of your future and really make a difference, because achieving any measure of external understanding requires a level of internal understanding. So I want you to ask yourselves a couple questions. One of them is just from do you think that based off of this information that we've gone over, that you are part of this group that we were discussing? And now with that, who do you think they're going to turn to for that revenue? Now, if you are, ask yourself, if you were the IRS, would you advertise to others innovative ways to reduce those taxes? Now, taxing entities are counting on the fact that you don't know what you don't know, and they're hoping that you don't take the time to educate yourself. Now, it doesn't make them bad people. It just is what it is. What's important is during this lesson today, continually ask yourself if you're maximizing everything available to you. Finally, when was the last time your CPA, business attorney, and financial advisor were on the same page working towards one common goal? And that's what's important to you. So keep the hamster going during this time that we have together, and let's begin by discussing from a high level a business concept that was revolutionized by the Tax Cuts and Jobs Act of 2017 and became effective on January 1st of 2018.
So before we talk about the value of adding a C corporation, it's important to know what we're not recommending. What we're not saying is jump on LegalZoom after the lesson today and set up a C corp. We're not attorneys, and this is dependent on your situation to know if one is applicable and two, if it makes sense. What I'm going to share with you is how some of our clients have added a C corporation to their business world and unlocked new opportunities to run their business more efficiently under the new tax laws. So before we get too far into this, let's level set with what key changes have occurred. The first major change is the removal of a progressive tax rate from the C corporation structure. In the past, the top bracket at 35%, and it didn't take a lot of income to get there either. This resulted in the reality that getting taxed twice on your earned dollars, once at earning and then the other through distribution through a dividend or other means, will be more costly than just passing it through your regular income. The flat 21% tax rate that became the reality in 2018 means that double federal taxation is no longer a boogeyman keeping you away from the opportunity. Now, another additional benefit that came from the Job Act was the alternative minimum tax isn't part of the C corporation equation any longer. After the corporate AMT was repealed, the final point applicable for today's discussion is around business interest expense. Depending on how you finance your operations and how you run your business, you may be exempt from the 30% limit on the deduction for business interest expenses. So let's talk a little bit about how you're probably structured today. For most of our clients that come to us, they look very much like this scenario that you have up on your screen. And we're going to discuss the business owner in this scenario that receives a $250,000 wage and also takes a $250,000 distribution of profit. It's important to note this isn't a lesson in legality or taxation. It's just using simple math to demonstrate an overall situation that may or may not be applicable to you. It's kept simple for illustrative purposes, and we'll follow this journey of a hypothetical business owner throughout our conversation. That being said, here's how most business owners we meet are set up today. They provide a product or service, they generate revenue which goes in their business, and eventually just passes right through to their personal balance sheet. Through their pass-through organization, the top federal tax bracket is 37%. And since the structure is progressive, once you hit that top tax bracket, every additional dollar you earned is now taxed at that higher rate. Typically, business owners take a W-2 wage and have taxes withheld for what's reasonable for their role, and the rest can come out in a variety of ways. In this particular scenario, a K-1 or distribution of profits is used, which means this business owner will probably also make a quarterly estimated tax payment. Now we're going to avoid the accounting nuances here and just assume all the income is taxed at 27% after some deductions. This is just an example. It obviously takes work differently, but we want to stay awake here, so let's keep it simple. This particular person made $500,000 and had it taxed at 27% and potentially owed the government $135,000 in federal taxes. Now in this next example, we're going to show you some opportunities that could actually change that scenario. In this scenario here, the same business owner doing the same things, but the how is what changes. Conceptually speaking here, what's happening is that instead of just paying yourself a $250,000 wage and being forced to take the rest via distribution of some kind, we're going to go at it in a different way. In this scenario, we're being much more intentional about what we're doing by adding something known as a management service organization into the operations. The overview of this is about focusing on paying taxes on what you consume rather than all that you earn. By working with an attorney and a CPA, you can determine how much money you need to live on and get as close to that number as possible for your W-2 wages. By doing this, the scenario now leaves $250,000 available for the business to do something with. Now, there are a lot of things in your business today that don't really have anything to do with what your business actually does. I'm talking about information technology, sales, marketing, management, and all the other services that require your time as a business owner to perform them, but they don't actually directly sell or provide a service to the clients or customers that you serve on a daily basis. And because of this, we now have an approach where the business owner can take. Using an attorney and CPA, you can now create, as a business owner, a C corporation and put it in place as a type of legal agreement that was vetted by the CPA and attorney to ensure the compliance that allowed the main business to pay the C corporation for all those administrative services that take away from your time working with clients. In this scenario, $250,000 was determined by legal and tax professionals to be appropriate for moving into the C corporation. As a result, $250,000 is no longer subjected to your pass-through entity, and progressive nature of income taxation is now taxed at a flat 21% rate. After tax, about $200,000 now becomes retained earnings in that corporation. Now the other $250,000 is taxed as ordinary income just as before, but now we've unlocked the qualified business income deduction, and the potential tax impact is about $100,000. Assuming no other factors impact this, the potential savings is $35,000 a year. By doing this, the business owner just retains 7% more of their profit. So how does it work? Again, this is not a do-it-yourself project. It requires a lot of expertise and experience, but here's a basic concept of how. Your C corporation provides services for an amount that is specified by something called a management service agreement, and it should always be done in alignment with your IRS guidelines. This strategy uses the IRS's own system to make sure you win by not losing. In exchange for the services, the pass-through entity pays the corporation a fee for those services. Now, the crux of most arguments against the C Corp is that double taxation. There are definitely other considerations, but this is the #1 question that we get. And I'm going to allow Josh to talk about double taxation and why that's really not a component that we're worried too much about in the new tax legislation.
Well, assuming that everything else is equal and that there aren't other factors, this is really just math. So in a pass-through entity, you earn $100 and it's taxed federally at the marginal rate at 37%. So in this situation, you've kept $63. Now in a C corporation, you earn $100 and it's taxed federally at 21%, you've kept $79. Now if you take that $79 out and pay a 20% capital gains or dividend tax on that distribution, you're still arriving at $63. Now there are other factors like state income taxes, dividend rates, and income that can alter the capital gains rate, but just so we avoid kind of living in the minutia, straight line math is going to tell us that we arrive for the most part in the same place in the worst case scenario. However, this begs the question of what's the point of doing this if we just arrive in the same place as we were before? Now, the magic in this approach, it isn't just the potential tax savings, it's what you do with those dollars that you've determined that you don't need to pay for your life.
So as Josh said, since double taxation is no longer, a concern from a negative impact, what's the actual point of using the C corporation? Well, let's say that during this process, the business owner decided instead of taking the income right back out, something else is done with it. Something they may have done with it anyway, they're just doing it in a much more efficient way. The first example is paying debt more efficiently. We don't really need to do the math here. Paying debt with dollars taxed at 21% is way more efficient than doing that or paying that same debt with a dollar that was taxed at 37% or 27% for that matter. The same goes for reinvestment in your business, the market, real estate, or in some cases even goods and services. You can pay for those things through your pass-through entity, but you're going to be taxed at a higher rate, where in the C corporation, you're able to use that 21% tax dollar to pay for those same things or invest those dollars. Additionally, you can also use more efficient dollars to defer some of that compensation by creating other executive benefits and even plan the exit from your business. The name of the game here is efficiency. So what else can be done more efficiently? Obviously, you can do these things without a C corporation, and this isn't as much about deductions as it is just about being more efficient with your dollars. By creating savings in your taxation, you can pay business debt faster, pay for goods and services, provide benefits for yourself, reinvest in your business, reinvest in real estate or the markets, and even defer compensation for yourself for a future date. And this all ties into the grand strategy of one day exiting your business. It can be some or all. The important thing is that using retained earnings to make a difference in your world, you're not having to distribute it on your balance sheet and pay as much in taxes. If this particular business owner used that $35,000 that they were previously just throwing away in taxes, and they got a 6% return on an annual basis over 20 years with it, they've added an additional $1.3 million to their exit plan. Now that's a huge difference with small changes. Your efficiency levels can continue to increase when you look past just the business operations and explore how we're saving.
One of the mainstays and one of the primary vehicles that people use to save money today are qualified plans. And these are your 401k pre-tax saving strategies like a traditional contribution, profit sharing, and defined benefits plans. We're going to show you why it may not be wise to put all of your eggs in this basket, because we've got to remember that the IRS every year runs a 23% deficit that's worth 12 Warren Buffetts. Any deal that you receive from a tax perspective will likely cost you more in the future. It's just designed that way. And to kind of show you, I'll cover a little history of taxation so you can understand how we got to where we are and the outlook for the future of that taxation. Now, the first instance of income tax was introduced around the Civil War, but it wasn't really put into effect on a nationwide scale until 1913, when it was ratified by the 16th Amendment, and which was just in time for World War I. Now, really in its early years, income taxation really just applied to high income earners and didn't apply to most Americans. That all changed in 1942 when the Congress passed the War Revenue Act. It set the stage for income taxation we experience today, and it nearly doubled the pool of taxpayers. So the war ended, and the baby boomer generation, which was really thought to be the largest that would ever come, had millions of births as the service members re-entered the workforce and began having families. Now, in 1978, the Revenue Act was passed, opening the path for benefits consultant Ted Benna to champion the 401k. Now, twice in the 1980s, the IRS actually fought to invalidate the 401k, arguing that the tax receipts that they would get would fall too quickly. Now, over time, the government saw a risk of a tax-free wealth transfer and knew that its largest generation would stop working and paying taxes in 20 years. So in 1986, they added the required minimum distribution with the Tax Reform Act of '86 to recapture deferred taxation. I don't think that they really understood the massive wealth engine that they had created for themselves, or maybe they did. Now, as the government becomes increasingly dependent on tax revenues, the qualified retirement plan and required minimum distributions will likely continue to shape to benefit the collector of those taxes. And so we get this all the time. And so I just want to say, first off, we get it. Tax deferral seems like an ideal approach, but what we'll see is that the journey is much less important. What happens at the destination is more important. Now, the assumptions for this scenario are on the left column for your reference. Feel free to break out your financial calculators and follow along. As you guys will see, is that I gave tax deferral the best possible odds that it could have. So what we see here is that each year after putting $100,000 into a qualified retirement plan, and we tax it at the highest rate, you avoided paying $37,000 in taxes. Now, each year, your contribution of $100,000 continues to grow in the market for your retirement at a conservative 6%. So at the end of 30 years, you've avoided paying $1.1 million in taxes, and your investments grew to approximately $7.9 million. Now, when you turn 71, the IRS wants your earned income out of those deferred plans that they allowed you to defer in exchange for all the benefits they gave you all these years. Now they're going to start requiring you to take out something that's known as a required minimum distribution, or RMD, out of your plan. Now the required amount is determined by a life expectancy chart known as a uniform life table. And so somebody that's 71 years old, they're going to cast it out and say, well, we think that you'll live likely to be 97 years old. So 97 minus 71, we've got 26. And so they're going to divide that number, $7.9 million, by that 26, and that's how much you have to take out that year. And here's what that would look like. So now, trust me, we're financial advisors. We've heard this a million times. My taxes will go down when I retire. Sure, you won't have an earned income from your job, and sure, your income may fall on a lower tax bracket, but paying less in taxes is a far cry from what you're actually going to be doing. So it's important to note here that you're not crazy for thinking this. I don't think that we're designed as human beings to conceptualize our lives in increments of 10 years. It takes really intentional planning to do this in the most effective way. Now, assuming you begin at age 71 and your divisible factor is 26, we divide that by 7.9 million, and it gives us around $298,000 that we'll have to take as taxable income in that year. Now, the key with this is that you're no longer working, you're no longer running a business, so you are limited in your options for deducting that income. But the good news is your income is not at the highest tax bracket like it was before. So assuming with deductions you paid 30%, your tax bill that year is $89,000. And so look at that, you and everyone else they were correct, right? You are in a lower tax bracket. But the bad news is that your assets grew by 6%, you took less than 4% out, and next year your divisible factor becomes smaller. And so normally at this point in our conversations, the clients say, well, wait. What I meant was that my taxes would go down when I got older, maybe not necessarily right when I retired. So let's look at that. So you're 80 years old now, and your divisible factor is now 18.7. So to keep the math simple here, we'll just assume that your rate of return only matched how much you've taken out up until this point, nothing more, nothing less. Now you're 80 years old and you're going to take $422,000 in taxable income that year. Now you're no longer working, you're no longer running a business, so you are limited in your options for deducting income. But the good news is your income is not the highest tax bracket like it was before. But now you've had to become more creative to find those deductions as your R&Ds increase the need for those deductions. Now, by the time you're 80, you could have paid close to the entire amount that you've saved during your working years. In this situation, $1 million in taxes was recaptured in 9 years. In the 9th year, your tax bill is $126,000, and this problem will continue to happen every single year. Now, if you decided not to spend all of the R&D and reinvest it instead, which a lot of people do, you'll likely create additional tax implications for yourself. You'll take it out and you'll pay income tax on it, you'll invest it, and then pay capital gains taxes on those. Either way, you're paying income tax on it before you decide what to do with it. But life goes on, and we get to age 95, and let's see what happened. So here it is. You lived to age 95, you had an amazing life, and passed your assets on to your family. Anyone would be happy with that outcome. By then, you'll likely not have been able to keep rates of return at the same pace of the required minimum distributions. So let's just assume that you had $3 million remaining for your family. In your final year, at age 95, your RMD will be $348,000. Assuming the same 30% tax, you paid $104,000 in taxes at age 95, and you haven't worked in 30 years. Now, knowing that each year could be different, let's assume on average you paid $100,000 in taxes on your RMDs. And really, that's giving the impact of RMDs a pretty big concession. After 25 years, saving $1.1 million in taxes while you're working cost you $2.5 million in retirement. Now that $3 million will pass on to your spouse, who will continue to take RMDs, but now has to file taxes as a single filer. And if anything remains when your spouse passes on, it will go to your heirs, who will also pay taxes on it based on their uniform life table factors until depleted. So the point here is, we're not saying qualified retirement accounts or the IRS is evil, but it's important to understand that the IRS has a job to do, and that's generate tax revenue. Now, what the good news is that it's not too late to do something about it, to be a little bit more intentional. The key with all of this is that you've got options. The important thing to understand is that there is no magic bullet here. It's going to take more than talking to a few friends, perusing a few internet articles, and signing up for a quarterly Kiplinger's to effectively do this. It takes a financial plan. Now, whether you've used a straight line tax deferred savings approach until now, or you've saved nothing at all, it's important to have a blend of money or buckets to pull from. An important consideration here is that the taxation of any of these investments really kind of comes with a little asterisk behind it that says, unless you. Now, there are ways to damage, revoke, or otherwise invalidate any of the tax features of these, but generally speaking, these account and asset types fall into the following categories: tax deferred, tax advantaged, and taxable. Now, it's inevitable that most people have tax deferred buckets, which is okay. It's important to optimize them though. You may have a Roth feature inside of your 401k, likely cannot contribute to a Roth IRA in the traditional sense, and all income earners have the option to build cash value using a life insurance contract. It's particularly useful when you use it as an asset class. Now, finally, you have taxable assets, which is your regular investing accounts, savings accounts, your business, and any rental income will all be taxed as you benefit from it. Now, the best analogy that I can give is that what you decide to do today is a lot like climbing a mountain. You've got a long way up and just as long of a way back down. So when we think about this analogy, when you prepare for and begin your climb, you diligently plan your routes, you expect things to go wrong, you account for them, you pack all of the necessary equipment, rations, water, spare equipment, and ensure you're fit for the climb, and then step off on your journey. Now, if along the way you realize that something wasn't planned or accounted for correctly, you've got an opportunity to turn back and fix it. And now if you're climbing Mount Everest, you'd probably do that or risk paying the ultimate price for your decisions. Planning for a lifetime of wealth accumulation and distribution isn't terribly different. If you decided to neglect to correct anything or ignore warning signs on the way, you may still get to the top, but where it becomes a problem is when you decide to get back down. Now, just for this example, of all the climbers who died, scaling Mount Everest, 73% died on the descent. Just 15% died on the way up or before leaving their final camp, and the remainder succumbed prior to reaching base camp due to unrelated accidents or illnesses. But the connection here is that once you get to the top, your options of getting out of whatever situation you found yourself in become much more narrow. And like I mentioned in the beginning, you've only got one chance to get this right.
So now that we know that previously thought strategies may not have the most bang for a buck, let's talk a little bit about some other ideas that can complement a more diversified approach to your business and your life. Executive benefit plans, which are just forms of non-qualified plans that we can use to save for the same goals down the road. Business owners and executives are the ones who reap the greatest reward from these strategies and provide a way for you to save money for the future. You likely won't receive a tax benefit in today's world for it, but after the last lesson on tax deferral, this may work out in the long run depending on your situation, your goals, and how long you have to achieve them. This topic is about discovering the strategies that have been in place for years and years and can absolutely be maximized for you. It's adding a benefit used by nearly every Fortune 500 company, and it's a benefit you can put in your world as well. So first, let's talk about non-qualified deferred compensation. As with all executive plans, you can fund it in a variety of ways. Oftentimes, the most efficient way to fund this is using life insurance. Yeah, I said it, life insurance. Now, before you stone me and send me to the gallows for bringing it up, let me explain why. There is a benefit to the executive and the company. As business owners, you're both of these things. This is called a win-win situation. A key factor in using life insurance is because having a death benefit provides an ability for these plans to self-complete and potentially repay anything owed out of them back with the death benefit when you pass away. You can use other things, but nothing will be there to spring to life and pay back any usage of cash. The plan basically works like this. The company will pay you a defined benefit or dollar amount which comes to you as a taxable income at a predetermined time in the future. Let's take, for example, 20 years. It's not deferred compensation. It's not free, it's deferred compensation, not free compensation, but it goes back to the business as a deduction. Pretty beneficial if you own the business, right? It's flexible, and there are more ways than we have time to discuss that you can use this benefit, but there's the gist of how it can work to help you reduce taxable income, defer growth on the account, increase retirement income, provide a death benefit to your family before retirement, and close the retirement income gap, all while providing a living benefit of cash access and getting rid of the penalty-rich environment of a 401k. We also have executive bonus programs. A key difference with the executive bonus concept is that it's more for key employees, executives, and essential people in your business that you want to reward and retain than it is about you as the owner. There are things more beneficial for you as an executive bonus. If you want to attract and retain the best in your industry, this strategy can be a game changer. These are valuable alternatives to providing 401k profit shares, paying off student loans, and these can be set up for you, for your associate dentist as well. Now, in a loan regime split dollar arrangement, the business owner owns the policy that funds the plan, and the business loans the owner money to pay the premium, which would include interest, but you're just paying it to yourself. The specific rates are just determined by the type of loan you decide to use. In this plan, the business receives a portion of the cash value and death benefit equal to the loan until it's repaid, which again, you own. When the plan ends 10, 15, 20 years from now, the loan can be forgiven or potentially repaid from policy cash values. A third option is secure repayment from other sources. I'm sure most of you have heard of becoming your own bank. Well, this is a way to do it. You can use retained earnings to provide this benefit to yourself as a business owner and be able to access cash when you need it. As you can see on this slide, there are numerous benefits to these plans. Now, here's the secret sauce of maximizing this plan, and is a strategy used by the world's wealthiest people. Get a bank to pay for it. Here's a quick example. Let's say this business owner saves $200,000 a year. Regardless of what bucket you save in, after 20 years, you saved $8.7 million. That's an amazing nest egg, but what was the opportunity cost? Potentially owning 20% of that in a capital gains tax or 30% as an income tax over your life. How does the executive benefit change this plan? By leveraging your dollars for better use, after 20 years, you save $13 million instead. That's an amazing nest egg. Well, what was the opportunity cost? Well, you've got to pay interest on that annual $200,000 loan, but we'll use the same assumption of 7% rate of return in the market and just pay interest from our returns, giving us a net 3% annual gain in the left column. So that's taken care of. The bank pays $200,000 every year for 20 years on the right column. The interest used here is the current rate for those policies in the market. At the end, you owe the bank $2 million. Now you pay them back, and now you've got $11 million instead of $8.5 million. You've had two buckets to pull from. One of them is tax-free. You've had the access to the money the entire time. And when this business owner passes away at 95, millions of dollars are passed tax-free to their heirs. Not to mention, you likely paid less in taxes just by the nature of the asset classes you used. I know it sounds complex, but it's actually fairly simple to implement and maintain this plan.
So look, we get it. Mind's blown, right? Now, the most important takeaway from today is just understanding that you've got some options in front of you that can help you get to where you want to get in a more efficient way. Everything we discussed may not apply, but even doing one of these things can add a tremendous benefit to you, and you're never going to know unless you just seek some more understanding for yourself. You've learned a lot on this, and more importantly, by attendance, you've learned that you aren't alone. Our challenge to you is to take charge of your future, take responsibility for your financial fate, and don't let another day go by without exploring your options. You've worked too hard to get to where you are today. We'll meet with you for no cost, and the worst thing that could happen is, you learn something. We'll talk about what's important to you, understand where you're at today, and provide a recommendation on what next steps can be. The key with this is that, we're real people. We're transparent about everything. So the more questions you ask in that meeting, the better. Just send us an email or sign up through our online scheduling link. We'll post that up in the chat box. And, when we meet, we'll tell you exactly what we think, no gimmicks or no games. So we'll open it up for some questions now. We encourage you to stick around and gain any additional clarity for yourselves. And I'll give it a second here to see if we have any questions come in, and then we'll just kind of cover some of the ones that we get most often. Okay, so while the hamster is going, a couple of the questions, and I'll just kind of field it to you, Lee, is, what about the question of, my CPA says that there's still double taxation?
Yeah, and the way I'd answer that, Josh, is yes, there is still double taxation in the situation where you've set up a C corporation, you've recharacterized income into that C corporation, and then you determine or decide you're going to pull that money back from the C corp back to yourself to consume. The thing everyone has to remember is prior to the 2017 tax law change, you would actually pay more tax by accidentally moving money to your C Corp and then pulling it back to yourself than you would have flowing it through your passive entity. That has changed in today's world. So now in today's world, if you accidentally recharacterize too much income to the C Corp and you need some of it in the near term, you're going to pay the same tax rate as you would have if you would have just taken it as income originally. So it's no longer negative impact to you from a double taxation standpoint. The key really is to recharacterize income into your C corporation and then leave it there to do the activities you want to do with those dollars for the future.
So what happens if, even if that's, all well and good, what happens if the law changes?
Well, that's a good question, Josh. I mean, none of us have a crystal ball and know, if and when the tax law is going to change. We do know that these tax laws were put into place. Sunset provision on this is 2026. And so we know for the next 5 years, we have the opportunity to utilize this 21% flat tax rate. And 5 years is a long time, especially if you're saving, $15, $20, $30, $40,000 a year. That's real opportunity that's going to go by the wayside if you don't use it. The one thing we do know is the whole reason they did this for the C corporation and for the small business owner is to bring revenue back into our communities and back into the United States by way of the jobs that are created and the spending that occurs from the small business owner. And I think it's going to be pretty hard for them to make changes to this when they've seen all the positive impact that's happened over the past 2 years.
Yeah, absolutely. And what would you say, and I know that this, I hear this question a lot, what would you say, to the audience there if they ask the question of what happens if I get audited?
Yeah, I mean, obviously getting audited is never fun. It's not anything anybody wants to have happen, but, we're not worried about audits with this structure because it's a sound, true approach that we're using based on IRS tax law and tax code. And so, I've been in business 27 years. We've probably been doing this for the last 18 years. And we've been audited, 6 times to our client base. All 6 audits have come back day one with no findings. And the key to it is, not only using that C corporation structure, but making sure you've got a sound approach to how you set it up and that you've got firm documentation of why and how you're recharacterizing that income.
Okay. And so another question that we get a lot is, just this thing's been around for 2 years. Why hasn't my CPA told me about it? Why haven't I heard about this before?
Yeah, we hear that question a lot, don't we, Josh? I think for the most part, accountants by trade or historians. In other words, when they go to school to become a CPA and a tax accountant, they're trained to look at someone's books, look at what they've done in the past, and then tell them how much tax they owe based on what they've done. Accountants really are not trained to be advisors in terms of here are different strategies and things that you can put in place to reduce your overall tax burden. And so, it doesn't make them bad people. It's just the way they've been trained and how they operate.
Okay. And so, kind of in alignment with, some of the executive benefits, it's high level. It can be a little confusing at first glance. Is there a way to kind of just simply, put out there if, I've got these retained earnings, I'm getting this tax benefit, paying at 21% versus, my effective tax rate. How am I getting this money out? How can an executive benefit plan help me get the money out without having to pay tax?
Yeah, and I appreciate that question because, even when we put this presentation together, we were both hesitant of even putting slides together around executive benefit plans because we could spend an hour talking about each and every one of them, right? So it's a very high level that we went through. But the basic concept here is money that you put in your C corporation, you're really going to look at doing a few things first. One, you're going to look at, do I have any business debt that I can actually service out of my C corporation? And we're going to take care of that through our C corporation. We're going to look at unreimbursed medical expenses, also some costs of goods and services, typically around disability and life insurance. After we do those things and we pay our taxes on the C Corp side, the next question for most people, if not all, is okay, now I have it in retained earnings. How do I get it back out of that C corporation so I can utilize it in my personal world? And that's where executive benefit plans come into play, because the IRS has tax codes and sections that we can utilize where we can create an executive benefit to pull those dollars back out and use them over our lifetime without paying additional tax. And whether it's deferred comp or a split dollar arrangement, you know, those are plans that we put in our place for our executives so they can get that cash back into their world and have the benefit of reaping those dollars and using them over their lifetime without paying additional tax.
Yeah, absolutely. And you know, another really popular one that we get, and it's always submitted anonymously in the chats, but it's, you know, do you guys just sell life insurance or do you do investments? And if so, can I decide what investments I use? What does that look like?
Yeah, so when you take a look at White Rhino Financial, and Josh, what you and I have put together, you know, the whole reason for the team was not to sell anything, you know. You know, I've been in business 27 years, and most of us got started, you know, selling products, and it's just not how I want to work with our clients. And so I would say we're first and foremost financial consultants. We're taking a look at your business structure and what you're trying to do and trying to help you become more efficient. Now, through the course of working with you from a consulting standpoint, we put plans together. Inevitably, we're going to find areas where you have needs from an investment standpoint or an insurance standpoint or, you know, executive compensation standpoint, and we're going to help you place those products in your life. But, you know, I would say, you know, you use this line all the time, Josh, you know, if it has a dollar sign in front of it and it impacts your personal or your business life, we can help you in that arena.
Yep, absolutely. And so, you know, with that, you know, we just wanted to say thank you to each and every one of you for attending. Hopefully you got some actionable insights to really be able to empower yourself to make a difference. We host webinars like this all the time, so please be on the lookout for new topics. Tell others like you who might benefit from learning some more about them. Our next topic is actually on how to properly construct, build, and maintain appropriate investment portfolios. Contact information is down there at the bottom. Send us an email, let us know your feedback, or schedule some time with us, and we can show you a little bit more about what we can do for you. Won't cost you a thing to find out. And wanted to hand it back to Daniel. Any closing comments or anything else that you wanted to add?
And real quick before you hand it back to you, Daniel, in the chat box, we actually put a link for you. If you've gone through this information, you're like, yeah, I really need to have a meeting. I want to talk about my specific situation. Please feel free to click on that link, and that will populate our team calendar and just find a time that works for you and go ahead and schedule that initial meeting. We'd love to sit down with you and just get to know you a little bit and try to understand your situation and see if we can be of any help to you.